Welcome to Just Minding My Business Media. We appreciate you stopping by, and I am so excited to bring to you today Scott WEAVIL, who is the founder of Sierra Pacific Partners, a lower middle market investment bank focused on sell side mergers and acquisitions. Advisory services. I'm sorry. I'm getting so excited here. Sierra Pacific Partners functions like a real estate agent, but in the complex world of selling businesses rather than buildings. Scott began his career as a Wall Street M&A attorney working on multi-billion-dollar public company transactions and started Sierra Pacific Partners to provide expert advice and high touch service to lower middle market companies throughout the United States. Wow. Welcome, Scott. I'm so glad you are here. So let's define a little bit, M&A stands for and what that means.
Yeah, for sure. So M&A stands for mergers and acquisitions. Typically, Wall Street deals are done for as mergers a lot of times for a number of reasons, including shareholder votes and things like that. But usually in the middle market and down, we're not really talking about true mergers. We're basically talking about selling your stock in your business or selling your business's assets. And when we sell its assets, we mean everything. We mean the name, the reputation, not just, that printing press you got or whatever. But basically what we're talking about M&A is just no matter how it's legally structured, we're talking about selling your business
Oh, okay.
or buying a business, depending on what side you're on.
Oh, okay. All right. So, what is the most important thing that sellers can do to be successful in an M&A exit?
Sure. I mean, you obviously need a solid business, right? I mean, while there are situations where you can sell a distressed business that's not making money or is maybe even losing money under limited circumstances, you generally need a solid performing business. The better that business is performing, the higher price you're going to command. But even within that, things like showing growth over time, I think that's super important, showing that revenues are relatively stable. It scares buyers to see that, in 2023 you lost $2 million. In 2024 you're on pace to make $7 million. Stuff like that tends to scare buyers away a little bit just because of the high variability. So I think the consistency there. But one thing I think, or a couple things that, even assuming you have a high performing business to really focus on, is having very, very solid financials. As you move from operating the business and potentially doing your taxes for tax mitigation purposes, so you have to pay the least amount of taxes possible. As you move towards a selling mode, it's important to circle up with your CPA and let that person know, hey, things have changed. I am now trying to show the most profit possible on those tax returns. And I think that that's super important, having good accounting as close to generally accepted accounting principles as possible. Given your industry, that's something you can talk to your accountant about, but getting on accrual accounting if you're on cash accounting and start making those transitions. Because basically what the buyer's doing is they're looking at your business. They see it as a benefit stream. That benefit stream going forward is the profit, the earnings, right? That profit looks a lot less risky if they're projecting it off super solid financials. Less risk means they pay you more for it. If that profit still looks really nice, but it's based off some financials that we've got some misgivings about, that's riskier. We're going to pay less for that profit stream. So I think that's huge, solid financials. We're working with a client now that has a fantastic business, but unfortunately, she has written off almost everything. So her tax returns show negative income. And it's really, really hard. I'm not saying you can't. It's definitely a sellable business, but she's going to take a hit on the purchase price just because it's going to winnow down our pool of buyers, and they're going to have questions about the financials. I mean, I hate to say it, but the common saw in our industry is you can only steal it once. And so if you've already stolen it from the IRS, unfortunately, you can't get that money back from the buyer too, is sort of where we are there. So I think That's not, and I think that's a little harsh. I'll be clear that I'm not gonna say that one of the benefits of small business ownership isn't having a little bit of leeway there. But obviously defer to your tax advisor on what's appropriate. I think that's number one, and I think number two is having the business as independent of the owner as possible. And so, to the degree that you have systems in place, to the degree that, some owners talk to me and they're almost bragging about being the hero. Everything runs through them. They're putting out fires all day long, that sort of thing. Yeah, I mean, we get that you're working hard. That's great. But you got to understand, to a buyer, that sounds like a nightmare. Like day one, you were in a super stressful position. Guess what? You can't go on vacation because you can get called every 3 minutes, right? So I think the more you can start to, and for small businesses, this isn't going to look like you have a CEO and they update you at a board meeting once a quarter, right? That's wonderful, but that's not reality for most of us. So I think the message here is systematize and hand off what you can. Like, for instance, if you're the owner and let's take the example of an insurance agency. You're the key salesperson. You go out and play golf and you go to church with all your key clients, and you have all those relationships. A buyer is going to be really concerned about that. When you stop going to play golf with Sarah, is Sarah going to all of a sudden get her insurance online, right? And so transitioning those key sales relationships, and it doesn't have to be full. If you still go play golf with Sarah, maybe bring your vice president with you. Just little things like that can incrementally help.
Okay. So let's get back to the taxes for a bit, because most businesses is trying to save as much as they can from not having to pay IRS. So if a company is in that mindset and you're saying that they should try not to shield the income so much, so to speak, when should they start thinking about selling their business, even before they even are going to do it? When should they start thinking that way?
For sure. So it's always a case, and we'll talk about valuation in this context too, because it's sort of the same thing. It's, as in most things it's in life, it's what have you done for me lately? So generally speaking, your last year and your last 12 months are the most important thing. But for purpose, so that's for valuation. Now, obviously a buyer is going to use what they can. If your last 12 months are really strong, but you had a bad year 3 years ago, they're obviously going to point to that and try to get you down on price. But I think for the tax deal is typically 3 years, I would say. At every buyer is going to ask for 3 years of tax returns. Some will ask for 5, but that's usually around the time, if you're seeing it coming, that's a good time to start letting your accountant know that you're making a shift towards that. And the other note here is there's nothing wrong with add backs. Like, for instance, if you're a business owner and there's a great conference in Hawaii and you can network at that conference, or you could attend the same thing via Zoom, there may be tons of reasons to go to Hawaii, but just document those expenses very well. So when a buyer asks, you can say, yep, here's the plane ticket. This is what, rather than just providing, $5,000 worth of discretionary business travel.
Mm-hmm. Okay, I see. Because most people don't have the mindset of, I want to pay IRS.
Right. And you just have to shift it. I mean, I guess two things, what we're talking about here is for smaller businesses, depending on how small, you're typically seeing multiples in the 2 to 7x range, right? So, 2 to 3 are pretty common multiples for below 5 million in purchase price. As we get closer to 10 or 20 million, maybe that's when we'd see the 7x. But the important thing here to realize too is every dollar that comes off that net income potentially is $2 to $7 in your purchase price. So that's one way you can make that a little bit of an easier pill to swallow, for sure. But it's 100% a mindset shift. And I would say, if you're on the Main Street market, which we'll say somewhere less, $10 million or less, something that can be financeable by the SBA.
Mhm.
SBA lenders really only like to see add backs constitute at maximum around 20% of your net income. So if you're way above that, I'm not saying there's no flexibility there, but if you're looking at taking a company from a negative net income on the tax return to making, let's say, 500 grand a year, once you add the add backs, that's not going to be an SBA financeable deal. So you've just lost a huge pool of potential buyers that rely upon that financing to get to a closing. So what does that mean for you as a seller? That means you're either looking at businesses that can write you a check in cash. That means that you're looking for businesses with, revolving or other credit facilities that they don't have to go out and get specific acquisition financing. Or worst of all, you're going to need to seller finance the deal. You're going to need to provide 80-90% seller financing because no bank's willing to lend on it. So that's the real, that can be the real cost there.
Yeah, it almost sounds like real estate. The way you're explaining it, so because all of what you just said is the same thing you need in purchasing real estate.
Right.
The evaluation of the property, you know, a lot of time, unless you're doing cash deals. But the banks, if you're doing a regular consumer type purchase, is basically 3 years of tax returns, and then there's what you call people that's checking the property, making sure everything is like they said it was. So yeah, I'm feeling
And,
on that. Yeah.
and there's some flexibility here if you get away from the bank. If you can show and prove to a buyer, hey, the tax return looks the way it does for the reasons we all know. Here is substantial documentation to show, what we'll call them non-tax optimized earnings are. You may convince a private buyer of that, right? I'm not saying that that's not possible, but just know that banks are not going to have that flexibility.
Right, right. They're gonna go strictly by the books.
Yep, they're going to take the tax return. They're going to start with the tax returns, look at some add backs, and the banks may not. The typical add backs you can bank on from the bank. I don't mean that as a joke, but the owner's salary, depreciation and amortization, taxes on the owner's salary. Those are the basic ones. As we get beyond that, lots of banks will consider them, but it becomes much more wiggle room. So, and like I said, you may get further with a buyer that doesn't need bank financing, but just particularly in the, below 5 million, below 10 million mark, that takes out a lot of folks.
Okay. Wow, you talked about a lot of things that's important, things that sellers need to think about. So what are some of the mistakes you've seen?
Yeah, I mean, we're talking about one, right? Running your business for tax efficiency up until the day you decide to sell, right? You got to make that transition. But if we're talking about mistakes, I think mistakes that are made closer to the process,
Mhm.
I would say some of the big ones are losing confidentiality. Typically speaking, you don't want your employees to know until you close. Now, there's some exceptions to that. Like if if you got a key, VP who's going to become CEO post closing, your buyer is going to want to sign that person up to a contract. So, like, you have to let that person know. But I think that generally speaking, the tighter you can keep that circle, the better, because you don't want your employees to find out, get scared, and go look for other jobs. When as an owner, you care about them, they're going to be taken care of post closing. Similarly, you don't want your customers to think, oh, well, the person I have a relationship with is leaving. This is a great time to switch companies, right? So all those things are concerns with confidentiality. And I think we don't have stats on this, but generally speaking, confidentiality breaches can be traced back to the owner. In other words, you're emailing me, your M&A advisor, from your work email that your assistant checks for you, goes through it, deletes the spam. Then she sees an email from me, right? You other things like we see this a lot in manufacturing. Owners think it's real sharp to do facility tours with the buyer on Saturday, right? What you don't realize, though, is that contracted security guard at your gate, he's best buddies with all your employees. And so, come Monday, he's telling everybody there were a bunch of guys in sport coats here on Saturday, right? That's weird. So it's little things like that to manage the confidentiality. So that's a huge one. I think another one that we see is you got to keep running the business. And what I mean by that is don't think for a minute, yes, that private equity firm will kill you with diligence requests. They'll keep you occupied, 20 hours a day with that stuff. But at the same time, when it comes time, to sign the purchase agreement or to close, they're going to ask for that trailing 12 months. And if your performance is falling off, they're going to use that as an opportunity to renegotiate. So I think that's a huge one, Steve. You got to keep running the business as though the sale's not going to come through. And that's what I tell people. Until you get that wire transfer, we are not closed. I think another huge one is lean heavily on your advisors to understand the market. We see some sellers who are willing to give away too much. And I'll say, hey, let's not do that yet. That's not normal. But on the other hand, you cannot be completely one-sided and try to win on every single term, because just simply put, one-sided deals just don't get done. And I think those are some of the top three. I mean, I could keep going, but I think those are good ones to keep in mind.
So if people want to work with you, how do they do so?
Yeah, they just reach out to us. Sorry for the long name, but we're SierraPacificPartners.com. My email is Scott@SierraPacificPartners.com. You can reach us at 916-234-3667. I will say we're based out here in California, but we represent clients all over the US.
Okay. So, when a seller comes to you, of course they haven't a clue about any of this. So do you, as well as the things that you need, do you provide support, like, in education, things like that, to help them understand what they're about to do?
Yeah, absolutely. We try to walk them through the process and sensitize them, as much as possible as to how it works. And it's not one of the key things we drive home. We're a little bit off the peak of the residential real estate market, but this is not real estate. You're not listing a house that's going to have 8 offers on it by the end of the day. A house is a physical structure that people can come look at. They can have their home inspector come check for termites, etc. Diligencing your business is a lot, it's a more abstract process. And so deals take longer. And we for sure talk our clients through, the first thing we do when we even have preliminary discussions with the clients, we send them an NDA saying, hey, we're going to keep your information private. Then usually the next thing we do is we send them an information request for financials and certain other things that lets us value the business. And the valuation is super important, because if we and the owners don't see eye to eye on it, it's just not a good fit, right? We generally get paid sort of like real estate agents as a success fee. And if the owner has a view as to value that I don't think the market will bear, that's just not going to be a great transaction for us, because we're not going to get anywhere with it. And we try to be very honest about valuation, because we don't want to give our owners, we don't want to give them the wrong impression and them to, create retirement plans in their heads that may not transpire based on the actual value of the business. Right. And so the valuation is super, super important piece. And then from there, if a client decides to work with us, the next step is basically we request even more information. So you'll notice we're going to be asking for information from you as a business owner. And the quicker and more organized you can be about providing us this information, the better. And the better we'll be able to tell your story. We take the information you provided, we create a marketing document called a SIM, as well as confidential information memorandum that really goes into detail, has your business name, all kinds of stuff. So that's for buyers who are under NDA. To get those buyers under a confidentiality agreement, we create what's called a teaser, which is basically a 1-pager, sometimes 2-pager, that describes your business, but without listing its name or any collection of details that somebody may be able to use to identify you. And basically, we send that out to a buyer list of folks we think may be interested based on their participation in the industry or whatever. And we try to use that to get them under NDA and to get interest in the business. So that's generally how the initial process works. From there, we get some sort of interest level from the buyers, hopefully at the same time, which we try to guide them to. But our goal is to get letters of intent or term sheets around the same time, and that way we can pick what buyer we think we want to go with for the rest of the deal. And we help negotiate that and work on those terms. It always doesn't always work like that. You may have a business that we only get a little bit of interest. Our goal is to get a lot of interest so we can sort of have competition and pit them against each other. But if we don't, we've got to do what we've got to do. And sometimes there is only one buyer, and then we can negotiate with that buyer. But that's generally how the process works. From there, you sort of go to sign definitive agreements that the lawyers put together, and then we hopefully get to a closing.
Okay. Sounds just like real estate a little bit.
It's very similar. But again, I can't overemphasize the fact that it's not a building that you can go see and touch and look at. And so that makes the diligence and information process just a lot more important here.
Yes. Everything has to be accurate on paper. Is that
correct?
All you have to go by. Wow.
And organization on the owner side and responsiveness is just key too, because there's a thing called deal fatigue. And I've seen this. Like, if everything is slow and everything's like pulling teeth, and your buyer asks for something and it takes 3 weeks to get something that you ought to honestly be able to pull real time online and have in 2 minutes, first of all, you're sending that buyer a signal that you're extremely disorganized as a business, the fact that you can't pull basic reports quickly. But also, if you truly want to sell, we need to provide that information so they can verify what we've told them in the sim, and we can keep moving towards closing. The longer things get drawn out, the more probability there is something that's going to put a wrench in the plans.
And usually you probably can detect that at the level where it's just you and the seller. Because if they are slow to get you information, they're going to be slow with the buyer.
Absolutely. And I definitely tell folks, I'm not going to say that everybody's the quickest with information, but I've definitely had that conversation where I said, look, I'm happy to do whatever. I work for you, but like, this cannot be the pace when we actually go to market. If it is, we need to talk about if you're really ready. I understand if you're not getting it to me super quick because you have other priorities. I'd still rather you get it to me quickly, but it's another thing when we go to the buyer. But I 100% am noticing how quickly and how organized the information is that comes to me. Did you just forward me 1,000 emails with no context and I'm supposed to go through them? Or did you send me one email that says, hey, Scott, I've attached the following. Number 1 is this. Number 2 is this. Number 3 is this. Notice this about number 4, right? And it just lets me know the professionalism and efficiency I can sort of expect.
Yeah, it's an organization in terms of business. I can't imagine not being organized in a business. I don't care if you're selling pencils. You need to be organized.
Come work for me for a couple of weeks. You'll have a different view. But that is right. I think and all of this is just showing the buyer, not only just moving the deal along, but showing the buyer you're organized and transparent. Mm-hmm. Because a skeptical, cynical buyer can also view this not as just they're disorganized and incompetent, but they're actively trying to hide something from me.
Yes. So you have to be that third. You have to think in terms of the buyer. What would you do?
At all stages, I had a client that, was advocating for one of these one-sided deals, very skeptical of everything, wanted to put a lot of obligations on the buyer. And I'm all for that. Let's get the best deal we can, but it's got to be within the realm of reason or we're not going to get to a deal. And one of the ways I sort of counseled her was I was like, you have to put yourself in the buyer's shoes. Think how skeptical you are of that buyer Now, take that same skepticism, given the level of knowledge they have about your organization as of today, which is near zero, um, and put yourself in their shoes. And I think that's a good way to help move a transaction forward, is really try to figure out what your counterparty is worried about. And if you can figure out a way to show them that that's not a true concern, great. If it is a real concern, if you can figure out a way that that risk should be spread between the two of you in a proper way, then there's our solution.
Yes, absolutely. Because people gotta trust you. They gotta feel that trust.
I I will definitely say the smaller the deal, the more true that is.
Mhm.
But I want to give a caveat. I've seen some relatively large transactions where the parties just actually don't like each other.
Mhm.
You do not see, but they still want to do a deal together. They're like, yep, party seller, I don't like you. Buyer, I don't like you. But guess what? You have an asset that we want, and it's an asset you want to sell. That can happen. That is very, very rare.
Well,
That even for the larger deals, there tends to be some trust or the deal doesn't get done. Again, it's not a house. The buyer is very, very concerned that there are things they don't know about, that they aren't even aware that they're big deals that they don't know about.
right.
And what bridges that gap? Trust.
Wow. Yeah, trust is huge. Integrity, that's a huge player in almost every transaction, because people need to feel like I'm trusted. You're being transparent about what the actual thing is. You know what I'm saying? So I get it. Because I know I would be.
No, for sure. And that is like the risk, it's different risks, right? The seller is worried that there's going to be some kind of gotcha that they weren't prepared for and they lose money. And that is a risk, but it's one, if you have good advisors, good lawyers, you can really help mitigate. The buyer, on the other hand, it has much more risk because they're not familiar with the business. They don't know, you may be very comfortable. Hey, yeah, it takes 100 grand in working capital a month. No, you don't need 2 months of that. I've been operating this business for 30 years and we've never had two down months in a row, right? The buyer doesn't know that. The buyer's also new to the industry, maybe.
Mhm.
Um, and so they perceive a lot more risk and just aren't aware of what they're not aware of. And because of that, they're going to be cagey and they're going to ask for more information.
Yes, yes. Wow, Steve, this was great. I mean, Scott.
Yeah. Oh, you're fine. I have an aunt that calls me Steve. I'm good with it.
I don't
So,
know where that came from. But anyway, how do people connect with you again?
yeah, they can just go to our website. We got lots of information, sierrapacificpartners.com. They can email me, Scott at sierrapacificpartners.com. Our phone number is 916-234-3667.
And what I do like is there's no fees until the deal is done. I do like that.
Correct. And I will say, though, because of that, we're careful who we work with, right? We want to make sure that we're aligned on those value expectations, that you're actually going to be, a reasonable and organized person to work with.
Yes, absolutely. Absolutely. Because definitely don't want to be working with somebody dragging their feet. I mean, because you want the deal to close just as much as the seller. You both should be on the same page. We get
Exactly. And to be clear, we're not, even though that is how we get paid, and I like deals to close, we're not trying to force sellers to close deals with folks that they don't trust. 100% no, I don't want anybody to close a transaction with someone they don't want to. But on the other hand, I do want to sense that if we find the right buyer, you're going to do your part of the job so we can move things forward.
absolutely. Wow, this has been great. I definitely learned a lot because I mean, you don't know what you don't know. And this was very important. And anybody that's out there that's looking to sell their business, you have definitely dropped very, very important information that they need to pay attention to going forward. And definitely reach out to Scott because he definitely got this down.
Yeah, we're happy to help. We love working with sellers. I think right now, There's a movement called ETA, entrepreneurship through acquisition. What I'm trying to say is it's a very trendy, buying businesses is very trendy among MBAs and younger folks in general.
Mhm.
And there is a ton of marketing and information directed at that buy side, but there's a little less education and marketing and stuff on the sell side. So anything we can do to sort of help even the playing field is something that we're happy to do.
Yes. So thank you so much for taking time out of your busy day to share all this good stuff with us. And we're looking forward to having you back, Scott.
Fantastic. Thanks, Ed. I really appreciate it.
Absolutely.